Hey everyone, Tyler here, back with another video. Today we're going to be doing something a little bit different. We're going to be talking about should you buy or should you rent? And we're going to be doing this series based on people's income on should they buy or should they rent. So today's video is based on an annual income of $50,000. So if you would be interested in me going over your numbers on YouTube so you can see what your income could afford, you can find some information down in the description. Fill in that information, send that over to me by email, and I'd be happy to do that on another video. But today, like I said, we're going to be doing it based on an income of $50,000. And to do this, we have to answer a couple questions. First off, how much can you afford based on a $50,000 annual salary? Then two, what is the cash needed to be able to purchase said house? And then three, we're going to compare buying and renting based on those numbers. So without further ado, let's go ahead and get started on this video. Okay, so here we are. What we're going to take a look at is our monthly income. So I put the information here. $50,000 salary, that comes out to be about $4,167 per month that you'd be making. We'll come back and we'll do a co-borrow income if your spouse has an annual income. Let's say $30,000. We'll probably throw that in here. And then we also have to include liabilities, monthly liabilities. So here is where we would put in loan liabilities, credit cards, student loan payments, child support or alimony that you'd be paying. So we're going to make this really simple and very clear cut, and we're just going to have one car payment of $450 a month. And then the last is housing expenses, what the semi-annual taxes would be approximately. Mortgage insurance, that probably should be closer to about $100 a month. Okay. And then all we have to do is drag this down to about 4%, which is where rates are currently at. And that is going to give us our number. So around $167,000. Now, the question is, now that we know what you can afford with $50,000, how much down payment do you need to be able to do that? So you're going to roughly need about $15,000 to be able to purchase a house. Okay, so now that we know how much cash it's going to take to be able to buy a house, about $15,000, $16,000, now we're going to have the conversation of should you buy or should you rent? And really why we're doing this conversation is because if you're going to rent, you would have an extra $16,000 that you could invest in the market. So historically, we see right here that the historical return on a stock investment is about 10%. So we're going to base you taking $15,000, $16,000 and investing that in the stock market and getting a 10% return. Is it better to do that, or is it better to take that $15,000 and put as a down payment and then hope that the value of your home increases over time? Now, I've based the appreciation of the home at 2%. Now, this is grossly under what we've been seeing the past 2 years of 10, 15, 20% annual home appreciation values. But I want to do this at a very base level because not all the time are we going to see these high appreciation rates, and we're going to see something that's either stagnant or something closer to this 2, 3, 4% appreciation on an annual basis. So here we got a monthly rent of $1,450. I'm going to come back to this here later in the video because this is really, really intriguing. When I just change this number $50, it's going to be crazy what you're going to see. Okay, so we're going to start at $1,450. Your tax income based on $50,000 would be about a 12% tax rate. Okay, I'm not going to mess around with expected inflation. We're going to just ignore that for right now. And then we're going to have a sales commission of 6% because at some point you're going to have to sell to get liquid assets out of your home. You're going to have to sell it. So that represents here by this blue line. However, let me break this down by the monthly payment breakdown. This is where things get very, very interesting. We have a rent payment of $1,450. We have a house payment of $1,459. We have initial tax savings of $101, initial principal payment of $230. Now we're going to take this $230 and $101 and we're going to subtract that from the house payment because you're saving on taxes and that principal that you're paying towards the house actually is you. It's not a rent payment, so it doesn't just disappear. It actually goes to the equity in your home. So we reduce that number down to $1,127. Now, here's what we do when we look at this report. This is right here what we need to see here. It says if your house payment is less than your rent payment, we subtract that amount from your investment. So what's that saying based on this is that there is a difference here. What do we got? We have a difference of $323. So they're going to be reducing the amount of money that you're able to invest into the stock market by $323 a month. So since it's less than that, if we were to reduce this, if you could rent for less, look at that number just climb. Well, now it's 5 years. If you could find a 3-bedroom, 1 bath or 1 bathroom in a home, and you could get it for $1,200 a month, and you can get everything you want, it's going to be a 5.2 years for you to be able to see the return at a 2% appreciation rate on your home. Okay, but right now rates in Omaha at least are around $1,450, $1,500. But look at this when I just change it by $50, because we're reducing the amount of money you're making. Remember that $323? Well, if we add your monthly payment by $50 a month, that jumps up to $373 a month. Well, you actually start seeing your return go less, because you're at a $15,000 that you're going to be getting at a 10% annualized return. If you're losing $373 a month, that actually is less than what you would be making with that 10% return. And that's why you see this decline in this number. But you start seeing you get a lower payment. That's where things start making sense, my friends. So if you are $50,000 income, if you can find, for me, I would say the break-even number, I typically like buyers to be in a home for about 5 years. So I would say this is the number right here. If you can rent a 3-bedroom, 1-bath house for $1,250, you can get the space that you want. It would make sense, in my opinion, to rent, because most people are only in their homes 5 to 7 years. And if you're in your home from 5 to 7 years, you're in that range where it really would make sense to potentially rent and just have that money building for you. Now, you're probably asking the question, well, the stock market's going to crash. What if the stock market crashes? Well, we're not having that conversation, because the real estate market can crash too. The real estate market, if it crashes, home values go down. If the stock market crashes, stock prices go down. So we're eliminating that from the conversation and just saying, if nothing else were to change, which would make more sense by having a $50,000 annual income. And here I would say that numbers, if you can rent for $250 a month and get everything that you want, or it's $1,250 a month, that would make sense to do it for 5 years. Now, if you're planning, this is a forever home and you're going to be there long term. Well, if you look at this right here. The expected return after 10 years for that investment is $65,000. Your net sales price is $71,000. So that's a $5,000 difference at a 2% return. Now, if I was to change this to what the standard is 4%, you're going to see numbers a lot higher. Now, I did a graph over the past 20 years of my city. In the last 20 years, home values have increased 107%. I made a video right here. You can check it out. But if you break that down and divide it by 20, that comes out to be about 4% per year annualized. So a closer number for appreciation in home values is probably right here. And so if that's the case, it's only going to take 2.1 years for you to turn your equity into a better return than you would if you were to put it into the stock market. And that's at that $1,250 or $1,250 payment for monthly rent. If we increase that If you're at $1,400 and you can't find anything else, my friends, that's 1.5. That is a no-brainer. You need to be buying a house, getting that equity in the home, letting the home value appreciations increase over time. And the longer you're there, the bigger that gap gets. So these numbers really are based on your area. If it all depends on what your rents are, it all depends on what you can afford, what housing prices are. Can you even get a house for $167,000? In my market, it's possible. It would be a 3-bedroom, 1 bath, 1 stall, or no car garage at all in some cases. So it is possible, but it's definitely at the lower end. So if you would like me to run numbers specific for you in your scenario, in your state, please check out the description. You'll find some of the criteria of what I would need to do this effectively. And then please reach out by email. I'd be happy to do that, guys. Hey, thanks for watching, guys. If you like videos like this, please consider liking this video and subscribing to the channel down below this video. In addition to that, guys, check out this video right here where I made just for you guys. Thanks for watching. I love you all, and we'll see you guys in the next video.